think it's about 12:30, so we're going to go ahead and get started on this administrative webinar that we're hosting here today. A few people are probably still going to be joining, so you might hear some clicking as they come online. But anyway, my name is Mychelle Holloway. I'm a senior administrator here at SES Advisors. Quite a few of you are probably familiar with me, and my co-speaker here today, her name is Kelly, and a lot of you are probably also familiar with her. She handles, not only does she do record keeping for us, but she also is in charge of our end of the year 1099 945 process, which is going to be a big part of our topics here today. Wanted to let you know about a few features on this Ready Talk screen that you guys are seeing. At the bottom, you should see a chat box where you can actually type in questions. Kelly and I cannot hear you, but we can see anything that you type into that box. So if you do have any questions as we're going along, just please go ahead and take advantage of that. Of course, our information is on the very first slide. If you have any other questions that come up, either during the seminar or afterwards, please contact either Kelly or myself, and we would be happy to just get back to you. So what we're going to be talking about today is things that you need to be doing at the end of a calendar year. Not all of you guys probably have calendar year ESOPs, but these are some topics that even if your plan year end is something other than December 31st, you still need to be thinking about this just because it's the end of a calendar year. Of course, like I already said, one of the big topics is Form 1099-Rs and the Form 945. They're all based on calendar year activity because those forms go to participants, and people file their taxes based on a calendar year. Another topic that we're going to go over today is required minimum distributions. And this is for those folks that are over age 70 and a half. And this, again, this is based on a calendar year, regardless of what your ESOP plan year in may be, because it kind of ties into the participant's tax return. So then we're going to go over a few other things, not in as much detail, but just sort of hit on them, that you could really do at any time throughout the year, but end of the year just seems to be a good time to just get that checklist out, go through all of this sort of information, and just kind of a good time to just wrap up loose ends and go ahead and get the slate clean before you start that brand new 2014. So we're going to get started, and Kelly is going to kick us off. She is going to be talking about Form 1099-Rs and the Form 945. A lot of you that have SES as your record keeper will be getting this information in the mail shortly. So she's going to sort of just go over, what it all means and how to best, supply the information and data that SES needs so that we can do a really good job for your participants and get them the tax information that they need. So with that, Kelly, I'm going to go ahead and turn this over to you.
Okay, thanks, Mychelle. The Form 1099-Rs are filed to reflect the reporting of income and dividends from pension plans, including employee stock ownership plans. Each Form 1099-R contains specific information to a recipient, such as the recipient account number, which for our purposes is the Social Security number, or the participant's beneficiary Social Security number, as in a death benefit distribution, and any address information will appear on the 1099 as well. The gross distribution amount and any taxes withheld, such as federal and state withholding, will be reported on the 1099-R. Distribution coding is reported in Box 7 of the 1099-R to represent the type of distribution processed. So for this instance, if SES or your trustee are preparing your forms, please let us know or them know of any special situations such as death benefits, payments, disability, quadro payments made to any other individual other than the participant as well. The Form 1099-DIV was previously used to reflect 404K dividends and capital gains of stock from an employee stock ownership plan, But now that information can be reported on the 1099-R form, it's used for reporting as code U in box 7 for designation of dividends rather than just standard distributions. The Form 945 is filed to report all federal income tax withheld from non-payroll payments or distributions on a calendar year basis. Be sure to check with your trustee or TPA to determine who is preparing the Form 945 on your behalf, as it is reported once on a calendar year basis. If SES is preparing then the Form 945, we will ask for a deposit history to indicate the month the deposits were made rather than the month the checks were written to ensure timely deposits have been made on your behalf. Federal tax withholding reported once on a calendar year, but if there was no tax, zero federal tax withheld for that year, then a Form 945 does not need to be filed. The taxpayer identification number used on the Form 945 must be consistent with the tax identification number used on the Form 1099-R, as both forms are submitted to the IRS, and the federal tax withholding amounts must match one another. As a reference, the tax identification number on 1099s should match the Schedule R tax identification number that was filed with the Form 5500. All employees, taxpayers, anyone who has received a distribution for the calendar year require a Form 1099-R, and they should receive a copy of that form by January 31st for tax filing. The employer has a February 28th IRS deadline to file the copy A of the Form 1099-R. Form 945 must be filed by January 31st if a payment is included with submission. Otherwise, if deposits were timely and full payment of taxes for the year processed, the return can be filed by February 11th. Some tips for processing the 1099-R and Form 945. Confirm that both federal and state withholding has been deposited timely. Please keep in mind that if SES is filing the Form 945 on your behalf, we do not take care of the filing requirements for each state withholding for taxes, as each state requirements do vary. Determine who is preparing the forms for you. Are you preparing the forms, your TPA, SES, or your trustee? Again, alert your TPA or trustee of any special distribution circumstances such as death, disability, or distribution under a quadro. ESOP sponsors who wish to file their own 1099-Rs can do so, but the forms need to be filed using the forms issued by the IRS. I will be sending out information to any of our clients that we prepare the Form 1099-R and 945s. That should be coming out probably sometime after Thanksgiving. And please read the filing instructions carefully to avoid any potential penalties. Mychelle?
Okay. A few more things just to add to what Kelly said. As Kelly mentioned, we will be sending out to all of our clients a data request sort of questionnaire probably sometime around Thanksgiving, just asking if you want SES to prepare your 1099s, and kind of a reminder that if we're not going to prepare them for you, just make sure that you're either doing them in-house, or if you have an outside trustee, they will actually prepare them for you. So we just want to make sure that everyone is just on track to get that information collected so that the forms can be done. As of right now, we think that the IRS has the forms in draft format. They're usually final and released around Thanksgiving, sometimes right after. So as you're doing your distributions throughout the year, this isn't really a process that you can keep up with as you do distributions, because the forms aren't ready yet. So that's sort of what everyone sort of has to wait until the end of the year to get the right format. As Kelly was talking about, timely deposits are very important. For federal taxes, you need to, in most cases anyway, you need to deposit those federal withheld taxes by the 15th of the month following the month that you wrote the checks. So if you're writing checks in November, you would need to make that federal deposit by December 15th. And that's what Kelly is going to be checking for when she asks for the deposit summary, to make sure that all the deposits were done in a timely fashion. And again, another thing to keep in mind is SES does not handle state taxes. Every state has their own set of rules and their own sets of forms. A lot of states don't even require withholding. So you may be in a lucky situation where you don't even have to do state withholding. But if you are in a state where you have done state withholding on your ESOP distributions, you need to make sure that you've contacted your state and you know what their requirements are. They may have an end of the year form that you need to file as well. So another thing, I don't see any questions popping up, but if you guys do have any questions regarding 1099s or 945s, definitely just don't hesitate to type that into the box or get up with Kelly or myself later. Some of the things that we see that come in on the data requests that can sometimes be a little confusing is gross amounts versus net amounts. We're looking for the gross distribution. We want to know what was the total amount distributed from the plan. And then there'll be a separate column where you can enter any taxes that might come out, and then we can actually calculate net by just subtracting the two. So make sure you don't just give us net distributions. We want the gross amount. We actually need to determine whether it was a total distribution or not, so we need that information. Another thing to keep in mind is some people get multiple distributions throughout the year, and sometimes they can't be added together. They might be a taxable distribution where they did not roll something over, and then part of it might be a rollover distribution. So you're going to have to break that out and let us know, okay, $5,000 was rolled over and $5,000 was taxed. So that can get a little confusing, and we'll talk about that more. That happens a lot with required minimum distributions, which is going to be our next topic. So keep that in mind. Let's see. I'm trying to think of other things that come up. We have a few questions coming up. Kelly, can you see these questions?
Yeah, I can. I saw I get confused over distribution codes. That is a very confusing aspect of the 1099-Rs. It's a matter of providing all the detailed information for the individual who received the distribution, such as their date of birth, gross amount of the distribution, and we can research that information and determine which code would be appropriate. The main codes that we're looking for is whether or not the 1099 should be issued as a rollover. So if those funds were rolled over to 401k or another type of account, we would need to know that information as well. The other question about filing more than one 945, no. One 945 form should be filed to reconcile the federal taxes that were withheld for that calendar year.
And just a comment on the distribution codes. If SES is following your 1099-Rs, we can actually do the codes for you. What we may need to know that we might not know is if something happens to be maybe it was a check made to a beneficiary, so it's a death benefit. We should know that if we're doing your record keeping, but flagging death or disability is a nice thing to do for us. But as far as the codes, 1 and 7 and 2 and all that, we can determine that when we're actually doing your work. A lot of our clients, do like to send in the codes, and then we just double check them, and that's a really good way to make sure, between all of us, we should be getting it right.
Just to reiterate, Mychelle, what you had said, the main, as far as death benefits, we will need the Social Security information for the beneficiary. So while we need to know, obviously, the participant that information or the distribution came out of for account purposes, we do need to know the individual's detailed information for who actually received that benefit, so we can make sure the appropriate tax forms are filed. And the 1099-R does use the same identification number as the 1096 form. And yes, SES can file 1099s, but not the 945. We do that for several clients. They'll process their own 945 form, and we will process their 1099s.
Right, and I think a key thing to keep in mind is sort of this triangle that's out there that you need to make sure that the same tax number is in 3 places. So it has to be what's on the 1099-R and what's on the 945, and the same number should have been used to make the deposit of the taxes. Because what the IRS can do, not saying they necessarily do this for every single case, but they certainly will be reconciling what comes in on the 945, that tax number, with the account that you have with them to deposit federal taxes. So that account needs to reconcile. So it has to be the same tax number. And typically they can also look on the 1099-Rs, and they can tell how much withholding you reported, and then they're also going to, they could double check back on the 945. And you would expect all those numbers to be the same. So that's what you're looking for. You're looking to reconcile and make sure that whatever tax number you're using to deposit those federal taxes is the same tax number that you're giving to Kelly when she does the 1099-Rs and when she does the 945. You want that triangle of numbers to all be the same. In a perfect world, that's going to be your ESOP trust number, but there's lots of reasons why it's not always that. It might be your plan sponsor number. Perhaps you don't have an ESOP number set up yet. Some clients are still using their plan sponsor number, which would probably be the company's tax number. And then if you have an outside trustee, they might want you to use their number. So that's something to check with them about. But again, if you have an outside trustee, more likely than not, they're going to be preparing the 1099s and all that for you. So they would have handled that for you throughout the year anyway. But yes, we can certainly do, as Kelly said, we can do the 1099-Rs, but not the 945. So that's one of the possibilities that can be done. Kelly, do you know the penalties for filing late? We got a question about that coming from a different source.
I'm not sure for this current year that's coming up what the penalties are. I can get that information.
Right. I know it's usually like a per day penalty for any forms that a participant does not receive past January 31st. So, it's not, I don't think it's as steep as like not following your 5500, but it's certainly not a penalty that you want to incur. And as far as just, participant communication, it's hard, I guess, burdensome on them to have to wait too long in order to get the information that they need to file their taxes. So you want to be as prompt on this as you possibly can. We have a question about what goes into the net unrealized appreciation box. Deb, I'm going to get your information and contact you after this session. It's a little out of the scope of what we're going over here today. That's basically cost basis, and that comes from when you do stock distributions. And if you are doing stock distributions and if SES is doing your 1099s, then we'll actually calculate that for you. We also calculate that for some of our clients that do their own 1099-Rs. But that's a whole nother webinar onto itself. So I will make a note right now, and I will get back with you on that after the session's over. Okay, well, if there's no more questions about 1099s and 945s, we're going to go into the next big topic that you should be thinking about this time of year. Again, required minimum distributions are based on the calendar year, so it doesn't really matter when your ESOP plan year end is. This is something that you need to look at this time every year. Now, if SES is your record keeper, whoever's doing your record keeping is probably tracking it throughout the year. And when you get your plan year end information, one of the reports in there or distribution forms in there should be who we already know is going to have RMD for the year. And those would be the people that have already been age 70 and a half and already termed, and so they were already sort of in the process of getting those RMDs anyway. What we don't know at this point in time right now is, SES right now doesn't have any 2013 data for our clients because we haven't sent out those data request letters yet. So what we don't know right now is there anyone age 70 and a half, with an account balance, of course, that has terminated recently? So I know what I do for my clients, and I'll do it probably next week or the week of Thanksgiving, is I'll send out sort of an end-of-the-year reminder email. And one of the things I ask is that exact question: has anyone terminated, or do you suspect they're going to terminate between now and the end of December? Because if they're over age 70 and a half and they have a vested account balance, they're probably going to be have to start getting our RMDs. And we just got a question in about what is the difference between RMDs and regular distributions at retirement age. And the difference is, your regular distributions because of retirement age, that's based on your document. That is generated off the plan year end. It's also based on however your plan defines retirement. So that could be different for different plans. But required minimum distributions, this is an IRS code. This is it's a statutory regulation. So all plans, 401ks, profit sharing, ESOPs, all plans are going through the same process. So there's no difference between one plan and the next. These rules apply to all qualified plans. So the first thing we look at is someone who reaches age 70 and a half must begin to receive required minimum distributions, which I'm going to call RMD, by the required beginning date. Okay, so what's that? The required beginning date, if you are a more than 5% owner, and you look at that ownership percentage in the year that they turn 70 and a half, then you need to start getting your distributions by the April 1st of the calendar year following whatever year you turn age 70 and a half. But that's only if you're a more than 5% owner in the year that you turn 70 and a half. If you used to be a 5% owner, 40 years ago, that doesn't make any difference. It's the year that you turn 70 and a half that you check for that. Most people are not, more than 5% owners. So for most people, their beginning date is the later of the year that they turn age 70 and a half, or the calendar year that they terminate from service. So if you have someone right now that's working for you and they are age 70 and a half, but they're still working, they have no plans to retire before the end of December of this year, you do not have to worry about giving them any kind of RMD because they're still actively working. And that's even if they're part-time. So if they have not actually separated from service by the end of the calendar year, they don't qualify for RMDs unless they are a more than 5% owner. So an RMD is going to be, it's actually exactly what it says, every word. It's required. They can't not take it. You can't not give it. But it's also minimum, meaning it's not like it's a 20% installment. It's not a lump sum distribution. It's a required minimum distribution. And the minimum amount is determined by the IRS, of course. They have a life expectancy factor. So basically it takes the account balance and it will divide it by this expectancy factor, which is, I guess, how many years the IRS thinks they've got left. And it's a much smaller amount than what the whole account balance is. We got a question about, can the participant ask for a full distribution? Now, that would be only if your document said that. I have seen documents that said at age 70 and a half, we are going to choose to allow a participant to take a full distribution. But that needs to be in your document. That's not part of the law. The law just says they have to take the minimum amount. So check with your legal counsel on that. And then I had another question that says, do active employees receive the RMD on the April 1st, the year after turning age 70 and a half? If they're an active employee and they're still employed, the only way they would be forced to take an RMD would be if they were a more than 5% owner. Okay, so if they're still employed, they're not an owner, then they're not yet eligible for an RMD until the year that they actually separate from service. And then we had another question that says, can we look at all deferred accounts and take from here or other accounts like their IRA? The required minimum distribution rules are for each plan. So you can't just say, well, they took their RMD amount from their IRA, so the ESOP doesn't have to do it. The ESOP has to do its own RMDs. Your 401k plan has to do its own RMDs. So if you have a participant that's in the 401k plan and the ESOP plan, they should be getting that required minimum distribution from each plan. So it's a per plan law. Okay. We kind of talked about what is a 5% owner. 5% owner, and it's the year that they turn age 70 and a half that you're checking. Another thing to remember is that the owner attribution rules, the same rules that we use when we're determining who is highly compensated, apply. So what that basically means is if their spouse owns more than 5%, if their children own more than 5%, or if their parents own more than 5%. So it's that same definition that we use for highly compensated. So that would be something to keep in mind. Well, maybe he doesn't actually own more than 5%, but his dad does, or something like that. You would need to kind of keep that in mind when you were looking to see who was a 5% owner and who wasn't. And then a really good question, is the 5% ownership measured in ESOP shares or outside of the ESOP? And it is absolutely outside of the ESOP. For this particular task and purpose, what the ESOP owns is owned by the ESOP trust. So we're not considering what's in the ESOP to be part of that 5%. So you're checking for the 5% of outside of the ESOP. Okay, so what account balance is used? Usually, once someone gets started on their RMDs, it's pretty simple. It's the account balance prior to the year that you're doing. So that's a fancy way of saying if we're doing the 2013 RMDs, which is what we're doing now, I'm going to use the 2012 account balance, and that's for calendar year plans. If you had a different plan year end, then you would use the most recent, valuation that you had. So, and then again, once someone gets started on this process, it becomes every December, or before December. You don't have to do it in December. You have to do it before December. They are required to take their minimum distribution. The first year that someone becomes eligible is a little tricky. The first year that they become eligible, the IRS realized, well, if they terminate in December, you might not catch them. You might not think about it. Everyone's out for the holidays. So it could easily roll into the following year before you actually realized, oh, they terminated and they were over 70 and a half and we didn't give them that check. So for the first year that you're eligible, you get to wait until April 1st of the year following. Again, you don't have to wait until April 1st to cut the check, but they give you that little extra 3-month quarter there to just sort of catch those people. Because a lot of times, like if your record keeper's doing it for you, I probably won't get your census data until first quarter of 2014, and so at that time I can check. But that might be too late for someone that terminated in 2013 that was, already age 70 and a half. So that's another good reason to make sure you get your census data in early. So say someone's first distribution year was 2013, so you have until 2014, until April 1st of 2014 to make that RMD, you're still going to use the 2012 account balance. You're still going to use his age in 2013 because that is still his 2013 RMD. Now, later on in 2014, he has to get his second RMD by December 31st of 2014. At that time, you're using his 2013 account balance and his 2014 age. So the account balance is always for the year prior to whatever year you're doing the RMD for, and the age that you use is the age that they are in the year that you're doing the RMD for. So it gets a little confusing. I have some clients that give the participant a choice as to how they want to work this the first year that they're eligible. You don't have to. As long as you're meeting the, as long as you're not going past the required deadlines, you're okay. I have some clients that say, you know what, we do everything in the, the fall of that year, so we're going to do RMDs, November 2013. And then for those that sometimes just, oops, we just sort of missed that termination date, it's nice to have that extra quarter. Let's see. So the big thing about RMDs and why people don't like them is that they're not eligible for rollover. The whole idea behind RMDs, the whole reason the IRS did this whole big, tax code section, was they want to start getting tax money from these people. They're age 70 and a half or older. They've been having this money in a tax deferred account. Time to pay up. So you cannot roll it over. But if you're getting an installment distribution, and a lot of times this happens, a lot of times you have people that are getting retirement distributions and are also over age 70 and a half, the part of the distribution that is not the RMD amount, they can roll that over. And this is what we went back to when we were talking about 1099s. This is a perfect example of how you would have someone getting two 1099s in 1 year. They might have their RMD amount that they could not roll over, so that's going to come on a taxable distribution, 1099, and then the other distribution they did roll over. So they would get two 1099s, one showing a taxable distribution and one showing a rolled over distribution. Because the RMD is not eligible for rollover, you don't have to do the 20% mandatory taxes. It's a 10% tax rate, but the participant can elect out of that. So you give the participant the choice, and they might choose, I don't want any withholding at all, or they might say, go ahead and take the 10%. That's their choice. You have no idea what their tax bracket looks like or anything like that. Again, if they do not roll over the whole installment distribution, then the portion that was not the RMD amount, but that was just regular installment amount, if they choose to not roll that over, that's taxed at 20%. So when you get these people that are getting their RMDs and installments, it can get a little complicated. So definitely feel free to, ask your record keeper, what's the best way to show this, report this. Okay, I'm trying to see. Kelly, have I missed any questions on RMDs?
No, nothing in reference to RMDs, but I did want to follow up to the question of the penalties for filing 1099-R forms late.
Great.
The penalty for 2014, depending on when the forms are filed, range anywhere from $30 to $100 per form. So that was to answer that question from earlier.
Great. Okay. Well, I think
we're pretty caught up with.
I think I've answered all the questions. Yeah. If anyone has any questions about age 70 and a half distributions, definitely feel free to check with your record keeper, or again, you can always contact Kelly or me, and we can help you out with that. So a couple other things that you want to do, and again, now we're kind of drifting into the, if you're a calendar year plan, you have to do this now. If you're not a calendar year plan, you need to do this at the end of your plan year end, or you could do it now. So if you are an S Corp, Now, if you're a C Corp, you can just sort of doze off here for a minute. But if you're an S Corp that's sponsoring an ESOP, then synthetic equity is something that you should be familiar with and understand the consequences of having changes in synthetic equity throughout the year. What I'm, of course, talking about is the 409P test. So if you're an S Corp and you're doing 409P testing, which you all are, this is something to kind of look at because synthetic equity is a very broad definition. And every year when we send out the 409P data request, there's like an explanation of all the different types of things, for lack of a better word, that might be considered SE. That's what I'll call it. Because it could be stock options, stock appreciation rights, non-qualified deferred compensation plans. You wouldn't think that would be synthetic equity, but it could be. Sometimes employment agreements can be called that. So there's a lot of things that might affect your 409P test. So that's one of the things you want to look at. If you're head of HR, you may not even know some of the changes that may have taken place as far as stock options or SARs or warrants. So it's probably something to check with maybe your CFO as well and make sure that you know all the available information and data, because when you submit year-end information to SES or to whoever is doing your record keeping, they've got to have that, the most updated information in order to do the 409P test correctly. Another thing that you might want to look about is changes in family as far as who you've hired. 409P has a broad definition of family. It is brothers, sisters, grandparents, siblings of all those people, children of all those people. So like cousins can get pulled in. It's a very, very broad definition of family. So if you have a 409P test, you should be looking at that. And there could be people flagged on there as disqualified persons. Doesn't mean anything horrible, but you want to be watching for them and making sure that you're not necessarily hiring other people in their family. Not that you can't hire other people in their family, but if you do, let SES know. So also another thing that could affect your testing would be if you had a huge layoff or reduction in workforce for the year, because that's going to affect who gets your allocations for the year. If you used to have 200 participants and now you're down to 125, it's going to change who's getting part of the pie, which will change the 409P test. So what I usually do, again, with my end of the year checklist, things to think about, is tell my S Corps, if you think anything changed with synthetic equity during the year, let's pre-test, because you can pre-test the 409P test, and there may be, and you wouldn't know exactly if you had passed or failed, but you should be able to get into the parameters of knowing we're in big trouble or we're not. And if you're in big trouble and you haven't gone past your plan year end, you can still correct things, you can still revise things, you can still be okay. Once you go past the plan year end, there is no correction of 409P. You only prevent 409P. So all these sorts of things that could affect that 409P test, be thinking about them now. Now's the time to call your record keeper and say, we issued stock options. We probably need to, do a pre-test 409P just to make sure that we're going to be okay. I think these questions that are coming up, I think Kelly's handling them all.
Yes, a couple of questions came through in reference to 1099s.
Kelly, would you like to maybe tell everyone what the question was? Because probably more than one person had it.
Sure. It was going back to following up with the RMD amounts and whether or not a 20% tax is required. Mychelle?
Oh, okay. Okay, do I understand correctly? 20% tax is required, but the participant can provide a form to not have the tax withheld. Okay. For RMDs, the normal course of action is a 10% tax withholding, not 20. 20% tax withholding is if you could have rolled it over and you didn't. Now, an RMD amount you can't roll over anyway. So if you choose to not, so when the participant takes the RMD amount, they have two choices. They can take 10%, or they can check off that they don't want any taxes, at all withheld. The 20% tax withholding would be if it was an eligible for rollover distribution and they did not roll it over. So if someone was taking an installment distribution and say part of it was RMD amount and part of it was just a normal installment distribution, if they didn't roll over the normal part of that distribution, that would be 20% taxes. If they rolled it over, then they wouldn't pay taxes on that particular portion.
Those were the two questions.
Okay. So we're up to date on our questions?
Correct.
Okay. Another thing to think about, and again, this is for, you can really think about this any time that these sorts of situations happen to your plan. Partial plan termination. SES checks this for our plans when we get census data in to see if there was a partial plan termination for the plan year that we're testing. Basically what this is a calculation of the turnover rate. The turnover rate is the top part of the fraction, the numerator, is the number of participants who had employer-initiated service during the, and usually the applicable period is usually the plan year. You can get into situations where you test different periods, but that's usually done with legal counsel help. So, and then the denominator is the number of participants at the beginning of the plan year plus anyone who became a participant during the plan year. So basically what you're testing is the percentage of participants that terminated during the plan year. If it's greater than 20%, then it's considered to be a partial termination unless you as the plan sponsor can prove otherwise. The burden of proof, if it's over 20%, is on you as plan sponsor. If the turnover rate is less than 20%, it's not been a partial termination. But there's numerous reasons why it might be more than 20%, and you might be able to not consider it a partial plan termination. One is that's your normal turnover rate. Maybe your convenience stores or some kind of a seasonal employer where people come and go, lots of rehires. So if that's your normal turnover rate, then you wouldn't be considered to have a partial plan termination every year. Let's see, I just think of this. Another thing that you can do is you can look at employer-initiated service. Severance. Now, what this basically means is it's something the employer did that made that termination happen. And those are the only people that you have to count in your test. So if you have someone retire or they became disabled or they moved or they got a better offer, if it was something they did that caused them to leave service, then that's called voluntary. That means they left of their own choosing. The other way is involuntary, and if it's an involuntary termination, you fired them, the position was closed, the factory closed. If it's anything that the employer did to force that termination to happen, those are the people that have to count in the test. So you might be able to lower the fraction below 20% just by taking out the people that voluntarily left. What you want to do for, if you are in that case where you're sort of relying on that, you want to make sure you have documentation proving, that they left of their own accord. So you might have, their resignation letter saying that they were moving or they found a better offer or something like that. And just keep that in their records. If a partial plan termination has occurred, then what happens then is that the people that separated from service become fully vested. So if you had someone that was only 20% vested because of their years of service, they're going to become 100% vested. So for some plans, this isn't a big deal because sometimes those people don't have a very large account balance anyway. Maybe they didn't work enough hours to even enter the plan. But for some plans, this can be a huge, expensive deal. So definitely, if you're close to that 20% threshold, seek some guidance. Another thing to be thinking about, and again, this is something you can do this time of year or when you send out statements or whenever you have the time, is locating missing participants. There's always that handful of people where their forms come back, from the post office that they, invalid address or whatever. There's actually some steps that the Department of Labor says you have to do to try to find these people. And one is use certified mail when you mail stuff because you might get back a forwarding address. Another one is to look at the other plans that you're sponsoring and see if they have a more recent address. So that's your insurance plans, 401k plan, any other plan that you have that maybe the person contacted them. You can also go to the beneficiary forms that you have on file for the ESOP or for any other plan, and you can contact the beneficiaries and see if they know of a valid address for that person. There's free internet searches out there. There's social media out there. There also could be people that are currently employed with you right now that maybe they were best friends or it's a brother or a sister or some family member. They might also know, more information about this person you're trying to find. What we can't do anymore, the IRS used to have a free service where they would actually forward letters to these people based on the addresses that they had, and they no longer do that anymore.
Mychelle, we had a question come in about individuals. What about people below 21 years of age? Locating them?
Right, locating them. Well, it would be the same process. There really isn't a minimum age threshold, so you would go through the same steps to try to find them, as long as they had a account balance. I mean, if they never entered your plan, if you happen to have, age 21 or older to enter your plan, then they may not even have an account balance. There's some optional search methods that you can also use. There's some paid-for internet search tools, commercial locator services, credit reported agencies. You can actually use the fees that these options incur. You can actually charge them to the participant's account. What you want to do, though, is you want to make sure it makes sense. If someone's got $50, don't spend $200 trying to find them. If you still can't find them, then you need to go to your document. And your document probably has some of the following options. They might have safe harbor language where you can actually roll that over. That's usually only for an account that's $5,000 or less. You may be able to roll it over into your 401k plan. Not that that solves your problem, because then it's just your 401k plan that can't find them, but at least you have all their money into one bucket. And then there's also your document may allow for forfeiture of that account, and you can reallocate that to other participants for that year. The caveat there is if that person comes back and they're found, you have to reinstate their benefit if they ever make a claim later on down the road. And then one last thing to kind of look over as you're just wrapping up your year is, have you provided summary plan descriptions to all participants? I generally say for this to go ahead and do it when someone's actually hired, because a lot of plans these days have this retro entry date. So you could have someone that, is hired in June, works 1,000 hours, and their date of entry in the plan is actually January 1st, before they were even hired. So if you're giving that out as part of your, welcome on board package, then you're doing the best you can. Same thing with beneficiary forms. While they're filling out their 401k, life insurance, all those forms, let them go ahead and fill out the ESOP forms too. And then your summary annual report, that's the little one-page summary that sort of sums up what the Form 5500 said for the year. If you're a calendar year plan, you have to have that out by December 15th, so that deadline is coming up. So I think we had a few more questions.
There were 2 other questions that just came in reference to distribution checks. Distribution check is not cashed by the former employee.
Right. Okay, so the first question is when talking about partial plan terminations, if someone's less than the age of 21, would they still become fully vested? And the answer is yes, if they fell into the employer-initiated severance group. There isn't any sort of age limit on that. And the other question is, if a distribution check is not cashed by a former employee, can the company escheat it to the state? Possibly that would have to be in your document. And before you do that, you want to go through some of those other optional methods, like checking other plans, checking beneficiary forms, contacting the beneficiaries to see if they have addresses. You don't want that to be Plan A, but that certainly could be, once you've exhausted some of those other methods, that may be what your document gears you towards. So that should be in your document somewhere as far as what to do when you've exhausted the other sources. Okay, Kelly, do you have anything to add?
No, I think we about wrapped it up.
Okay.
The only thing is that, again, any clients that we do process the 1099-Rs and Form 945, I will be sending out the questionnaire via email to our contacts, and just please let us know whether or not you would like us to process the forms on your behalf or not.
Okay. And again, if there's any questions, just give us a holler, but I think that's going to wrap up the end of our webinar here today. So again, thanks everyone for hanging out with us.
Thank you.